Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall. I'm bringing the energy today, along with my low energy, very good friend, the voice of the people, Jeff Santoro. Hey buddy.
I am not low energy. Just because I said I was tired before we hit record has nothing to do with the energy level I bring. I am a professional.
Okay, all right. I'm not a professional.
No, I know.
Yeah,
I know. That's why we're a good team. I'm a professional and you know things about investing.
It's true. It's true. You know what I know a lot about? You look through my portfolio over the years, you'll see a lot of broken theses. Theses.
You know, two podcast hosts that prepare to record might have looked up the plural of thesis.
Yeah.
But we did not.
We're Investing Unscripted for a reason. So that's the show. That's the show. The title is The Broken Thesis. And we're going to talk about just that. How do you know when the thesis has changed? When is it broken? Following companies as they evolve is hard. Deciding when to hold, when to move on can be even harder. So I'm going to talk about some of our own personal experiences with that, Jeff, and like how to figure out when you're just anchoring on the idea that you bought the stock. Right. And trying to be objective in the situations where things have changed and you need to reevaluate.
Well, and it's a good follow-up to last week's episode where we talked all about, ruining a good stock by diversification or changing what you do and when that has worked out and when that hasn't worked out. And this is, I don't know that we necessarily planned it this way because again, we don't plan. But the logical next step to that conversation is, how do you know? Like, how do you know in the moment whether A, your thesis is broken, B, maybe it's just changed, but the new one is okay, right? Let's go just real quick to kick things off here. You could use Amazon as the example, right? Let's say you were a diehard believer in online book sales.
Right.
And then all of a sudden, Amazon starts offering DVDs as well and CDs, and you go, whoa, wait a minute. It's not what I got in this for. And you bail, right?
Yeah,
That's a silly example, but you could have made that decision when AWS came around or when they started developing original content for their streaming service. And at any point where they branched off, you could have said, my thesis is broken, I'm out. And that would have turned out to be the wrong decision. And then the other kind of piece of this too is like, I have a stock in mind we'll talk about later where the thesis is different than maybe what it was, or my thesis for owning the company was different than someone else's, and someone else is now saying it's broken and they bail, but I stay. Like there's all these weird kind of nuances that you have to kind of think through. So it'll be a fun conversation.
Yeah, I think so. I'm looking forward to it. All right, where are we going to start?
So here's the thing I say a lot that I don't do as consciously as I wish I did. I truly believe you should know why you own a company.
Mm-hmm.
And I like saying know why you own a company because I don't know, maybe it's me. I know what the word thesis means. I'm an educated man. However, when I was a brand new investor and people would say, oh, the thesis is broken. What's your thesis? What's the thesis for this? I didn't really know what that meant for a stock. I knew enough to intuit what it meant, but I didn't really in my bones understand what it meant to have a thesis for owning a stock. And once I learned more and I kind of figured out what it was, I liked to think of it more like, what is your reason for owning it? Like, what is the thing you think the company's going to do that's going to make it a successful investment? I know that's not as snappy as thesis, but I don't know. So I just want to say that out loud because I feel like if I felt that way as a brand new investor, there's got to be some other newer investor who's like, why does everyone keep talking about thesis? Like, what exactly does that mean? So I like to think of it as know why you own a company. And I wish I was the kind of person that, sat down with a piece of paper and wrote out an actual thesis statement for why I own everything. I don't really do it that deliberately or explicitly, but I think I'm able to now, at this point in my investing journey, tell you why I own every company, like what is my thesis. But I think as a practice, I wish it was something maybe like I had to do before I was allowed to click the buy button. Yeah, I would have probably saved myself a lot of mistakes. But I'm just curious because you and I have never talked about this. Where do you land on the idea of formally or informally or written down or just in your head laying out a thesis for owning something?
I think about a couple of different ways, but I think as a general rule for me, the thesis is kind of like an elevator pitch. And for those not familiar with that term, it's essentially you're in the elevator with something and you've got from the time that the door closes till you get to the floor that person's going to get off to explain something to them in a compelling way that they're going to walk away and say, okay, I understand that and it makes sense. And I think that broadly, I like to have a pretty straightforward thesis. For example, I'll just put Care Trust REIT out there, ticker CTRE. It's a real estate investment trust that has built great relationships with good caregivers in the senior living and nursing home space. And they make their money by owning the facilities and tenants paying leases on it, and by lending money to some tenants for them to acquire properties. The growth opportunity is the tailwinds around the aging demographic and the fact that this is an industry that is wide open for consolidation, and they're a small player that's proven their chops at capital allocation and making lots of small acquisitions to grow. That's it. I mean, that's the thesis. So over time, you have to measure that, right? That's the next
thing I want to talk about. Yeah.
Interesting. Yeah.
Yeah, because I think I like elevator pitch is another way of thinking about it. But I'm glad you said, and you have to know how to measure it, because I think that's the next step. After you know why you own it, and you can say that in a short elevator ride to someone, obviously you're not going to bore that person in the elevator with any more detail than that. But you, as the investor, need to go home and be able to track the things that are happening or not happening in the business that tell you that your reason for buying the company still makes sense.
Yeah.
Right. It's still on track, so to speak. Right. And that's where, you and I will talk a lot about KPIs or key performance indicators. And some businesses straight up tell you, like even using that language, these are our KPIs. These are the things you should track that will tell you if the business is on track. And some of the better ones will even tell you, here's why this is not a good indicator. For some companies, it might be revenue. Revenue might be choppy, but if you look at billings, that's a better indicator of how the business is doing, or the other way around. Billings will be choppy. Revenue is the best indicator. Same thing with bottom line. You just mentioned a REIT. With REITs, it's not necessarily earnings per share or net income. It's FFO, funds from operations. That's why digging past what the AI generated article you find on the internet about earnings will tell you is super important, because they will just spit out the same metric for every company, whether it's relevant or not. And you really do have to understand what to pay attention to.
Yeah. And the key thing about those KPIs that you talked about there, or those, in the case of REITs, funds from operation, is the better proxy for earnings because of the way they're structured, is anytime you're looking at metrics that aren't earnings or cash flow, you need to understand how they relate to that, right? How do they direct the company's efforts towards growing those cash flow outputs, right, over time? So it's not using them instead of, it's helping inform whether the aspects of the business are performing in such a way that it is going to result in growing those returns for shareholders over the long term. I think that's just a really important part of it.
Yep. All right. Thesis, figure out why you own the company. Next step is obviously understand what metrics to keep an eye on to see if your thesis is on track. But then comes the event, right? The thing that happens that either changes or potentially breaks a thesis. Do you have any specific companies you want to start with? I have one or two in mind, but I know you had some as well.
Well, this earnings season has certainly given us a number of companies, and I'll mention a couple now. And just this is a teaser too, that, this is a stock that's in our Savvy Trader portfolio. It's one of our worst performers, and it's the Trade Desk. We've seen the Trade Desk. It's been a massive winner over the long term, but this year we've seen the stock take two massive hits after Q4 earnings, and then again after they reported their most recent earnings. And the bottom line is, like, the core part of the thesis, I think we can argue, is continuing to play out. Programmatic advertising is growing. More advertising is moving online. It's moving to streaming, right? It's moving away from print. It's moving away from traditional broadcast media that's becoming smaller and smaller. Podcasting is becoming a bigger ad source, thanks to our advertising partners, by the way. You mentioned that. And where the trade desk fits in is helping advertisers get the best return for their advertising dollars, to put the ads for their products and services in front of the most relevant viewer that they can, right? To increase market uptake and awareness of whatever their products are. And so that part of the thesis continues to play. Revenue is up double digits. They're guiding for revenue to continue to grow double digits. But where the question comes in is the part of the thesis about them just being so dominant and retaining their dominance on the buy side, right? Working with the ad buyers, the brands, the ad agencies that represent them, whether they're going to continue to be so dominant, because the growth rates have slowed a tremendous amount. And it does look like their transition from Solimar to Kokai, I wouldn't say it's problematic, but it certainly has decelerated. And you can have a business that's still winning in the market, but because of the expectations and the valuation that you're paying for the business, that's where that disconnect happens. That's where the thesis can sometimes become uncoupled.
And that's an interesting example, because I often think about a thesis being busted by a decision the company makes. But if one is to believe that the trade desk is, the thesis for owning the trade desk is currently busted or is being busted by just changes in the market, that's a different way of thinking about it, right? Sometimes it's just the thing you thought would happen doesn't happen and therefore busted, right?
Right.
And I think, companies that don't survive, that's, I think, often what happens. We talk a lot about companies that are currently publicly traded that we currently own, but it's because I think you forget about the ones that go to zero or delist or go private again, and then you just forget that they even exist because they're not publicly traded anymore. Like, I'm just going through, I keep a list of all the stocks I've ever sold just to kind of see what happened after I sold it. Did it continue to go up? Did it go down? And it's interesting. It's a mix of good decisions and bad decisions, obviously. But what's interesting as I scroll through it is how many of these companies no longer are even publicly traded and have gone private or maybe went away. And I don't even know what's happening with them anymore. And you could probably go back and point to a point where whatever the thesis was that made it a publicly traded company that was successful at one point is now busted. So I think trade desk's an interesting example of how that can happen. I don't know that I'm ready to say it's busted yet.
Yeah.
Because there's also just the chance that they're going through a rough patch. I even the most successful companies in the world over decades have times when they just struggle and go through difficult. I mean, we talked about last week, we talked about Netflix and the decision to, when they started doing the streaming and when they were going to at one point split off the streaming business from the DVD business and that whole debacle. But a more recent example we talked about on the podcast was Amazon at like the end of 2022, heading into 2023, when all of its e-commerce business was just bleeding money, operating losses quarter after quarter, basically just being held up above water by AWS. And the stock got super cheap. And there were people saying that this was, that I don't know if they were saying the e-commerce is broken, but seriously questioning the business. And it just turned out that, no, there was a good reason for that and they fixed it. And it's okay now.
Right.
And that's the challenge.
That's it. That's exactly it. And what we've seen with Amazon is at some point along the way, the idea of optionality with Amazon became a bigger and bigger deal because they started showing off things like AWS, where they could stand up these things often that they were using internally and sell them to external users. And they've continued to add layers and layers onto their business in ways that other retailers have never, ever, ever done, right? It's a technology company that happens to sell TVs, right? It's the incredible example of a company that has evolved over time in successful ways versus empire building and diversification. It's like the classic example of like mission creep, often driven by management compensation to grow the empire and not actually create per share value, where what you end up owning is so vastly different from what you started with. what do you do? And I think you're right about the trade desk too. I don't think the thesis is busted, but I do think, and this is, I think, part of it too, is like, I think part of the thesis has to tie into risk reward. Does the valuation match up with the business's ability to generate return for you? What are those expectations? And I think maybe for the trade desk, I think it's fair to say that for investors' expectations in January or late last year of what the business would do, I would say that thesis is busted, that this is a company that can continue to grow revenue at 30+ per year, year over year on a regular basis. We saw revenue growth 27%. The first half of last year, 22% the first half of this year, and last quarter was 19%, right? So still trades for 65 times earnings. So whether you say thesis was busted, but the business is still worth evaluating and keeping on a watch list or holding, like in my case, I'm going to continue to hold for at least some period of time because the growth is there. Because we've also seen companies go through these sorts of growing pains and figure it out. You mentioned Netflix, right? And I've talked about the trade desk maybe being in a bit of a Netflix moment where with Netflix, it was making the transition of trying to move as many customers from physical DVDs to streaming as possible. And the trade desk is trying to move its customers from a legacy platform to a more AI-driven platform and getting your customers to make changes that you want them to make is really, really hard to do. And we're seeing that happen with the trade desk. So definitely a situation where resetting expectations is probably the nuance in here versus being a busted thesis.
And just to take Netflix as an example one step further, there was a much more recent time when I think a lot of people were saying the Netflix thesis was broken. 2022, I want to say, when they had that first quarter where their year over year subscriber growth was actually negative. And the stock sold off, I think, 35%. Someone who's a co-host of this podcast, not named Jeff, said that they were toast and pointed out that it was the first time that they were ever really seeing competition and that they weren't, it was over for them essentially. And I'm teasing you, but there were a lot of people who felt the same way, right?
Yeah,
like,
no, it's true.
The whole thesis was built on the fact that they were the streaming service, and now there's 11 other streaming services, and they're never going to survive. And it turns out, no, they're still the best one out there that everyone needs to have. And they pivoted, right? They started to add supported tiers, and that was part of, if not the whole reason, everything kind of turned back around.
No, that's exactly right. Reed Hastings, former CEO, is the chairman now, one of the founders, said for many years, Netflix would absolutely never have ads, right? And they have ads. And it's been wildly successful and more valuable on a per user monetization level than the ad-free tiers. So it's remarkable. And they're still pretty early in monetizing that, but they're still optimizing it, I guess is the key.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks Podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks Podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
So another company that comes to mind and about the Broken Thesis idea, I'm reminded of it because you and I argued about it in real time as it happened a little bit, and that is Boston Omaha. which is a company that you and I both, I think you still own it. Maybe you sold your shares. I still own it.
Completely sold out.
I still own my shares. We both used to really like this company. So just really quick, if anyone doesn't know, they have three main parts of their business now: billboards, broadband, insurance. And it used to be they had a big fourth bucket, which was probably the most exciting part of the business, this asset management.
External investments.
Right. And they were going to start to, well, it didn't start as that. It was just asset management. That was the part of the business that was doing the fun things, like the SPAC that turned into Sky Harbor, and the one making other sort of equity investments a la Berkshire Hathaway, kind of building that portfolio. Right. And then they started raising funds from external investors to invest alongside with them.
Trying to raise funds.
Right. And then that all went away. They wound that down. One of the co-CEOs left the business. He was the one that was more interested in that asset management capital stuff, and he left. And the disagreement that you and I had at the time was that you thought that was busting the thesis, because for you, if I'm remembering correctly, and tell me if I'm wrong, that asset management part of the business and the co-founder, co-CEO that was interested in it was the reason for you. You were really interested in the business and thought it had long-term potential. For me, it was just like a part of the reason I liked the business. So I was willing to wait and see what it looked like in a world where this change had been made. But a lot of people, including you, were like, this might be a busted thesis. And now here we are a couple years later, the stock has done nothing. The company has basically just treaded water. So
a lot of opportunity cost for investors too, because of how well the market's done. So,
right.
And yeah, no, I think that's largely it. And I don't think we disagreed. I just think you were wrong that the whole idea of the business was to have optionality around where to allocate capital best. And some of the opportunities would be internal to add to those existing operations. Some of the opportunities would be external, like finding maybe another SPAC to sponsor, or investing, in the asset management business because they were going to focus on like build to rent real estate. It's one of the things they were going to focus on. And as soon as the co-CEO structure changed and they wound down that venture, largely because my understanding is they just really struggled to get any traction with raising the sort of capital that they would need to do anything. The original thesis behind the business massively changed, because it was no longer about this internal and external hunt for opportunities to create return. It was entirely about capital discipline and operational efficiency as a company doing three, frankly, very disparate things: surety insurance, billboards, and broadband, right? Rural broadband. Those three things have zero efficiencies from being part of the same enterprise. They don't add any strength. As a matter of fact, the challenge you run into is three different businesses that are going to be asking for capital, and management's going to have to decide who they ignore sometimes. And inevitably, this is why you see a lot of times with conglomerates that end up spinning off businesses, those spinoffs do better because they're freed from those capital constraints of having to report to the home office and come with their hat in their hand, ask for money. So it's a very, very different thesis than the business would have been 4 or 5 years ago.
Yeah. Another one that comes to mind, and it's no longer publicly traded as of July 1st, but that's Redfin, the real estate broker. My reason for first buying shares when I really didn't know what I was doing, the thing that I was drawn to was they were trying to disrupt how buying and selling houses worked. And as someone who has bought and sold multiple houses and paid that 6% commission, I was really intrigued by a company that was trying to change that model and only have, I think it was a 1% commission, just a different model, right? Having full-time employee brokers rather than brokers who work on commission, and just trying to change the whole incentive structure for the business. After I bought those shares, they started iBuying, right?
Yep.
Which was, buying houses and flipping them and selling them. And that a lot of people called a thesis buster, right? That's not why I own this company. That's not why I wanted to be a shareholder. Now, I was too new and naive to know anything, so I just held on and went for the ride. And then they ultimately stopped doing that, but the business never really super recovered, and they got bought out by Rocket Mortgage. But yeah, that's another one that I think of when I think about the broken thesis. that one pops into my mind immediately because that was related to what they did, but certainly a very different animal, especially as it pertains to just capital allocation, like what you're going to use your money for to pivot into iBuying and then pivot right back out of it once it didn't work.
Here's another one that I think is a good, like, things going badly example. And of the ones that we've talked about, this is the one that's by far been the worst. And it's TPI Composites, which just filed for bankruptcy this week. And it's been probably close to 10 years ago I first started following the company. And TPI does something really important, and it's manufacturing wind turbine blades for the big wind turbines. And why this is important as a contract manufacturer is you've got most of the turbine manufacturers that are big global companies like GE Vernova, Vestas, the Danish wind turbine company. I think Siemens still, they may have sold their turbine business. There's a big Chinese company that does it. There's a couple of others, but the challenge is because these blades are so big, you can't really centralize manufacturing of the blades. And pretty much nobody has enough market share everywhere that it makes sense for them to have global, geographically located turbine blade manufacturing. Some do. Some have some, like in their major markets where they do a lot of business. But a lot of it goes to TPI Composites, and there's some other companies that do it too, because they manufacture for 4 or 5 companies, so they can get all of that scale, right? But like I said, they just filed for bankruptcy. So what happened? You had a company that was in a great position, strong contract relationships with these wind turbine manufacturers, but it's a highly, highly cyclical industry. Like the capital deployments by the utility operators and the grid operators and the big developers that develop these projects can fluctuate wildly from one year to the next, even though the larger tailwind, forgive the pun or don't, is growth for wind turbines. They got way ahead of themselves with their capital deployment to build out more capacity. Interest rates started to go up, demand went down. So the double-edged sword of high interest rates on their debt were hitting their books at the same time that higher interest rates meant all of the development was going to slow down. Their cash flows took a hit. They ended up having to go hat in hand to Oaktree Capital. I'm pretty happy that I was able to say hat in hand twice in one episode, Jeff, by the way. Oaktree Capital is part of Brookfield, is basically like a payday lender in the corporate world. They have money when nobody else does, and they always get good terms. So essentially all of TPI Composites debt, $400 million or so, was in extremely favorable terms to Oaktree, and a little bit on the onerous side to TPI Composite. Not structured to make the company go bankrupt, but structured so that Oaktree would absolutely get its pound of flesh, but also give TPI time to not have to pay a lot of interest up front or service the debt as they kind of restructure and resize their business. Long story short, multiple years have gone by, and it didn't work out. And they filed for bankruptcy, and they've got kind of a pre-negotiated deal in place. And so the business is going to continue to go. But what busted the thesis for this company, like if that elevator pitch was just because wind turbines, you've got to have a little bit of nuance that in a highly capital intensive cyclical business, the thesis is that they're going to be able to win by being a key manufacturing partner for the industry and leverage their scale across the cycle. And they failed, right? And the thesis broke really the day they took on the debt from with Oaktree. It became incredibly, like the threshold of difficulty was going to be much higher for investors to come out ahead.
So I want to talk about companies that maybe went through periods where the thesis might have appeared broken, but it turned out not to be. But before we do, this got me thinking about, there's a lot of examples of this, but there's just one that I know from my work with the Motley Fool on the discussion boards. Companies that have had really long histories, been around for hundreds of years or 100 years, but have done many, many different, completely different things than what they do now. So the example I just want to share, because I just think this is fascinating. So Brunswick Corporation, which probably not a lot of people have heard of, or if they have, it's not because of what they do now. Now they sell boats and boat parts, and they're in marine boating. That's what they do. 100% of their business, boats. That's for you, Sina. But I knew the company Brunswick because I bowled a lot as a kid. And if you've been to a bowling alley, all of the bowling pins,
Brunswick balls. Yeah. Yeah.
Since they were created as a company, which was in 1845 by John Brunswick, this company has been involved with billiards, rubber, back bars, bowling, defense, the music industry. They had a recording label, furniture for schools, sporting goods, medical equipment, technical, I don't know what that is. I'm just reading categories, fitness. And then they, over the last 10 years or so, kind of got rid out of all of that. And now they're just entirely in boating. So if you came across this company now, you'd be like, oh, I've heard of Brunswick boats, or my boat has a Brunswick engine on it. But that's all the stuff they've done since 1845. And
well, the funny thing about it is the thing that they don't do is bowling.
Right. Yeah. They've sold out of all of those businesses, but the names still get sold off to some other company that makes the bowling pin.
Well, it's like Corningware that you might buy at the store is not owned by Corning, the company that makes the glass for TV screens and smartphones.
But it's just fun. It is interesting when you find these companies that have been around for a really long time that have done so many different things that are not related to anything else that they've done, and then they're doing something completely different now. So anyway, not really what we're here to talk about, but I just think it's interesting and I wanted to share it.
I mean, I think that's relevant though, because the reality is that, we think about companies, we buy a company and like we stamp it in time as like, this is what I bought. And we project in linear fashion that this is what it's going to do in 5 years or whatever. Companies have to evolve, right? They have to. In the competitive marketplace, they must. Technology happens, consumer tastes change. All of those realities are there. So I think a good thesis needs to some extent kind of have that factored in. And to me, a lot of times when we're thinking about the thesis, are the factors that will derive shareholder value still supported by the business as it exists today?
Right. And the last thing I'll say too, with sometimes when you go through these corporate histories, like, it does, you start to see, like, I like how you said companies need to evolve, because as I click through the corporate history of Brunswick, a lot of the pivots they made might appear out of the blue, but actually when you see why, it makes perfect sense, right? So like they were in billiards early on, and then because they needed rubber to make whatever the padding along the side of the billiards table is, because they already were making that, they were like, well, what else can we use rubber with? And that's how they got into like an entire business around rubber, right? And then a war happens and they pivot because no one's playing billiards and like all this crazy stuff that one thing leads to another. But I just think about, like, if you were a shareholder all along this journey, like, would you be like, what, my billiard company is going to start making airplane parts?
Right.
A lot of broken theses along the way there. All right, what's a company on the other side of this, Jason, that you think has gone through this potential thesis breaking time, but come out in a better place?
We've already talked about Netflix, and we've talked about Amazon. Nvidia, I think, is a good example. So massive winner that's continued to win. And the reason I think it's worth having the conversation about these big winners and thinking about the thesis changing is, at some point, it may get to a point where your original thesis no longer applies because your exposure has changed in some way. So what I mean by that is thinking about Nvidia. When I first bought Nvidia shares, this is, I don't know, 2011, somewhere on there, 2012. They made video cards, and they made really good video cards for gaming. This is like right at the beginning of the first bit of interest for mining for Bitcoin. Right? Like, so much that wasn't even on my, bingo card for Nvidia. But what was on it was the CUDA platform that was a great platform for building the ecosystem for building things with their GPUs. And there was the first seeds were being planted for automotive industry for using them. Cars were becoming more electronic. EVs were starting to become more of a thing, whereas the idea is that this connected technology could be useful for EVs, but mostly just for cars becoming more and more connected, right? So those were some kind of early seeds that were planted. AI, data center was part of the conversation, but AI, some, right? Of course, some, but not anything like what it's become. And what we've seen happen is that over time, different parts of the business would do really well. Like the demand for mining for Bitcoin became so huge that they couldn't meet the demand for the gaming market, because all of the GPUs for gaming were getting snapped up off the shelf for people that were building rigs to mine Bitcoin. So they came out with standalone Bitcoin GPUs for mining. That's all they were for. So they stripped down all of the other features that were there for gaming to have a separate product to make sure the market was properly supplied. But those markets were countercyclical too, right? So if one was down a little bit, the other would be doing well. But that's what we first really saw in kind of the common era, the modern era for Nvidia. The stock gets super duper volatile with some really, really big drawdowns, is when Bitcoin mining was very boom and bust for a couple of years. And so that started going well, and then it wasn't going well. And then AI and LLMs come onto the scene, and it vastly changed the thesis for what Nvidia would be and has become.
Yeah.
It is a completely different, it's that, I don't want to say it's a completely different business. That business is so huge that you could spin off the video cards business, the gaming part of the business, and the valuation wouldn't change.
Yeah. Well, I'm glad you brought up NVIDIA, because our subscribers to our Patreon heard our rough cut about this last week. But my thesis for owning NVIDIA before all the AI stuff was exactly what you just said. I felt they were well diversified, right? They had the gaming, they had professional visualization, they had the automotive market, they had their data center market, and then they have like other, right? So they had these 5 kind of buckets.
Yeah.
And I noticed the same thing you did. Like, oh, okay, so gaming is down big this quarter, but look, automotive's up, and vice versa. And it would move around like that. So my, call it naive, because I was certainly a much less sophisticated investor than I am now, and I'm pretty still unsophisticated, was that, well, this should make them a little more resilient, right? Assuming all these different industries don't hit a cyclical downturn at the exact same time, the fact that you might see softness in one could be mitigated by strength in another.
Yeah.
And I don't think there's a person who's bought NVIDIA shares since ChatGPT came out who thinks about anything other than AI.
Entirely.
Like, there's no one buying shares now going like, well, that professional visualization business, that's why I'm here.
It doesn't matter anymore.
But no, well, see, this is where I struggle personally with, like, I'm not going to sell, but buy or hold, which is, it's not priced on a valuation basis much higher than it was back before AI. And it still has all these other businesses, but I also have to be realistic and understand that if AI falls off a cliff next quarter, the stock's going to crater. Like,
yeah, exactly.
Because that's just how these things go. But the
worth
business,
so
I think, would still
money.
be fine, because it was fine in 2019, and it was fine in 2020, and it was fine in 2021.
Right.
You know?
Yeah. But just this, I think here's some good example. The CapEx and this is actually from their most recent quarterly report that came out not too long ago. The data center revenue, capital expenditures, back in 2022 was, I don't know, 250 billion, roughly. You can't even really see Nvidia's share of that. It was just a couple $1 billion. Like, it was tiny. They're projecting that number in 2028 is going to hit $1 trillion or more, right? It's going to 4x. And Nvidia is getting a probably 5 times larger share of that pie than they were back in 2022. So the numbers are mind-boggling. But the key is that I think you have to acknowledge that this is a situation where the thesis has changed drastically. And largely, I think in good ways. There's no arguing that if you look at what the stock has done. And you think about that multiple that it's still
and what the business has done. I mean,
that's absolutely.
I mean, like we're looking at things like revenue and net income and that kind of stuff.
Well, yeah, that's what I was going to say. Talking about the multiple, that you think about where the multiple is, it's there because the company has generated such massive earnings growth and is expected to continue to do that for some period of time. It's pretty remarkable.
Okay, so we've talked a lot about theses that may or may not be broken, examples of ones that have been, an example of one that maybe has been for a good reason. Let's tie this up as we wrap up here. What do you do about this? Because this happens. I mean, anyone who knows the companies in their portfolio well can go through them and probably find anywhere from small to large changes that the business has made or factors that have tanked the stock or made the stock run up that you could say are changes of a thesis. How do you think about this in terms of what you actually do buying and selling and holding as an investor?
I think the starting point for me is separating the story from the operating results of the business as a starting point and almost as kind of a finishing point too, because if the story has changed along the way, the financial results are going to tell you if the thesis, whether it's changed or not, is investable or not, right? Does it continue to be successful? And clean energy fuels is an example that I can use. A stock. I still hold a couple of shares that I bought back in 2012 that are down they're down 95%. And, the market's, I don't know, probably up, 5x since then. But the reason I hold onto those shares, it's a reminder that a business can grow and get a lot bigger. And to a certain extent, almost build out a new industry in the case of clean energy fuels, selling largely renewable natural gas that's used for transportation, and investors can get left behind, right? Is that they've grown the business tremendously, but what they never did was found unit economics that would deliver return for investors. It's a little bit of what Roku's finally starting to show some unit economics, but it's never really fully delivered. But it's like the extreme example of a company that's grown, but has never delivered unit economics, right?
Yeah.
So it's a broken thesis.
It's not a broken thesis.
No, for clean energy fuels.
Oh, okay.
For clean energy fuels.
I was just defending Roku.
Yeah. No, it's fine. You can defend Roku all you want. But so I think that's the key is you look at the results. Amazon is a perfect example. The thesis has changed. It's certainly changed. It's not broken. It's just whether or not the way that it's changed, does the business still match up with what you want to own? But it's clearly deriving wonderful, wonderful unit economics and financial results from it. And that's, to me, that's the key is what do the numbers tell you and does it align with the story that management's telling?
Yeah, I think for me, it goes back to the exact same thing we said earlier, which is have a thesis and then know how to track it. And I think that you have to still do that when it changes, right?
Yeah, right.
I'm glad you brought up Roku because like that, the reason, now I could still end up being wrong, but the reason I've held on to my shares for all these years that the stock has underperformed the market is because I know why I own it. I own it because the world is going to continue to move to streaming and they are a leader, not maybe the leader, but a leader in selling advertisements on streaming media. And I know they're doing well because they used to report active users and average revenue per user, and they don't anymore, but they also used to report and still do streaming hours, and it goes up 10 to 20% every single quarter, year after year, without fail. And to me, that's what I want to see. Now, has the profitability story taken way longer to play out than I thought it would? Absolutely. Am I happy to see that they're finally starting to make some progress there? Yes, I am.
Yeah.
But that's the reason I held. And there was a little thesis bump in there. I mean, they started making other devices for some reason, like smart devices, like Alexa type things, or at least they announced that. I haven't heard much about it since. But that's the hard thing about this for me is that every time there is a change in a thesis, whether it's something the company does or whether I think it might be broken, like we joke all the time about Outset Medical, there's plenty of people who might be right saying that that thesis is broken. They're never going to gain enough traction with that kidney dialysis device to really be a successful investment. But when I look at the numbers every single quarter, I still see progress. So I hold my shares. And has there been massive opportunity loss by holding these shares for all these years? Yeah. I mean, not massive in the sense that it was like $1,000, but massive in the sense that like, if those $1,000 had been in Nvidia, I'd be in a much better position.
Right. It's the opportunity cost a lot of times.
The opportunity cost, exactly. Yeah. So I guess here's how I would sum it up. I think you, as an investor, you have to think to yourself, you have to weigh the opportunity cost versus the waiting to see if it plays out versus the sadness you'll feel if you sell and it turns around.
Right.
You know?
Right.
Like everyone's got that story about like, oh man, I sold Netflix in 2011, and if I had held those shares, I'd have $100,000 right now. Like everyone's got those stories. Anyone who's been investing long enough. So I think like that's the one side of the fear. That's the cut bait. My thesis is broken. Worst case scenario. And then, but on the other hand, it's like, well, I held these shares for 8 years and the stock's up 8%. Meanwhile, the market has risen 400%. You know?
Right. Right. I mean, that's the key. And honestly, those are the hardest ones to determine if the thesis is failing, is the ones that they're still there. You know, they're not down a bunch. They haven't really made you money, but they're just still muddling along, right?
Yeah.
Those ones in the middle. And for me, it's one of the reasons that I use starter positions for a lot of companies, is because when the thesis is working and the financial results are improving, the business is telling me, okay, I'm earning more of your money. Time to add to it. And the ones like the ROKUs and the Outsets of the world that are not earning more money, they sit there. And then if things start to get better, you'll notice.
Yeah. And
you circle back around to add. So position sizing, I think, is an important way to check yourself when it comes to thinking about avoiding the mistake of ignoring the broken thesis too much.
Yeah, agreed. Good way to end it. So if you guys enjoyed this episode, we'd appreciate it if you would share it with a friend and give us a 5-star rating and review on the podcast apps. Also, reach out to us. Hit us up on social media. Send us an email at investingunscripted@gmail.com. We want to hear your examples of broken theses, companies that you own or used to own that you bailed on because you thought the thesis broke, or maybe ones you held on to because you're not sure yet. We'd love more examples than the ones we gave. You can also check out our YouTube channel for some more videos than what we do here on the podcast. If you're interested in hanging out with us more, we have a Discord where we talk with subscribers to our Patreon starter position. That's $5 a month. You can come chat with us there. You can check out our Savvy Trader portfolio at savvytrader.com and see us use this podcast and all of our toolbox tools that we come up with to make actual stock picks in that portfolio. And the links for all of this are in the show notes.
All right, Jeff, we'll leave it right there. Just end things with our usual reminder. We love sharing our thoughts and giving our answers to these hard questions about investing, but it is still up to you to find your own answers to those questions. You know what? I believe in you. You can do it. Okay, low energy Jeff. We'll see you next time.
See you next time.